Hello and welcome back to my YouTube channel. So we'll continue with the revision and today we'll do question 22 for the August 2025 mock. Yeah, so I'll read the question. Callisto has collected the following information relating to the pro forma financial statements of XYZ Limited, a company that is a target of its competitors. Yeah, so we have this, we have earning before interest and tax, we have tax, we have capital expenditure, we have the non-cash working capital. So you are provided by the following additional information. Cost of debt is 5%. So just allow me to note it here. Tax rate is 25%. So I'll copy that here. Risk-free rate 1.5%. Beta at 1.3. Market return at 10%. Equity value 16,500. And debt value is 14,000. Yeah, let me just capture that. So determine the tax paid from year 1 to year 5. Yeah, so the tax rate is what they're working on. So we'll calculate the tax rate here. So we'll say equals to the tax rate we are given is 25%. Yeah, so we'll take 25% and you multiply by the earning before interest and tax, the IEBT, to get the tax rate. Okay. Yeah, so because the tax rate will be constant from year 1 to year 5, so I'll lock that cell completely by a $sign. Yeah, then I want my tax to be negative because it's an expense. So I'll put a negative before earning before interest and what? And tax. Then I'll just say enter. So once you enter, you can see it's giving me 1,000. So I'll drag for the other years up to the 5th year. Yeah, so those are the tax rates we have for that Roman 1. So we have answered Roman 1. These are the tax rate. So number 2, determine the free cash flow to the firm. So the free cash flow to the firm, we know that the formula is always the earning before interest and tax minus the tax. And that gives us what we call the net income. So we take the net income like this. Here we now have the net income plus depreciation and amortization. You less the capital expenditure, you less changes in working capital, or if there's any change in other assets. Yeah, so that means that my free cash flow to the firm now will be here. Free cash flow to the firm. Yeah, so we'll start with the year 1. Yeah, so we'll sum this. Yeah, from earning before interest and tax to non-cash working capital. Yeah, sorry, we continue. Yeah, so our free cash flow to the firm will be this. We'll sum all this. Yeah, so I'll highlight all that up to there. Then I'll go to sum here. Yeah, and I'll get that. So for the free cash flow to the firm for year 1 is 2505. Yeah, then I'll drag all that to year 5. Yeah, that's how we are supposed to answer that question Roman 2. So the free cash flow to the firms here. I'll highlight it. And then from here, I'll create a top border. Yeah, then you create a top border that way. Okay, so our free cash flow to the firm is that amount. Then number 3, using capital asset pricing model, CAPM, determine the weighted average cost of capital. Yeah, so we should be able to calculate our own weighted average cost of capital. So I'll do it here. WACC. And we are specific to the CAPM model, the capital asset pricing model. Yeah, so we are going to have 2 formulas. So the first formula, we are going to check at the cost of the equity. Yeah, because we have not been given the cost of the equity. So how do we get the cost of the equity? So it's always we'll have this formula. So we'll say the cost of equity, which is denoted as ERI R let me say or yeah, the cost of the equity. Let me just say ERI. Yeah, that way, caps equals to the risk-free rate. The risk-free rate RF plus beta. So beta is BI. Then in bracket, the expected return, the expected market return. Yeah, so ERM. Yeah, so ERM. Then you minus the risk-free rate. Minus the risk-free rate, the RF. Yeah, that's how you calculate the cost of what? The cost of the equity. Yeah, so this expected rate, it's always put on the bracket. The expected then return on the market. Yeah, that's okay. Yeah, so that's what we'll use. Then we'll also use now, we have to calculate the cost of equity before we get to the WACC. So what is the formula for the WACC using CAPM? All right, so the formula will be equals to, it is always equity, the value of the equity, when you divide, so you say over, let me do it here. So E equals to divide by, let me say bottom border there. Yeah, so E over E, which is still equity, sorry, the value of equity plus the value of debt, E plus D. Then we multiply by RE, which is the cost of equity. Yeah, so this one you will multiply, so you multiply this by times, sorry, times RE, but that's the cost of equity. Then you add, shift, you add again. Now you interchange, so we'll have debt, you add that. This column is so big. Let me undo this. Let me clear that. Then I see. Yeah, so let me have the formula here for the WACC. So the formula, we say that it's the value of the equity. You divide by E plus D, same value of equity plus value of debt. Yeah, the debt value. Then you multiply by the cost of equity, which is denoted as RE. Sorry, R in caps. Yeah, that's the cost of equity. Then after you have done that, you add now the value of debt. You divide by equity plus debt. Yeah, the same thing, values. Sorry, E plus D. Then you multiply by the cost of debt, which is donated as R in cap, then D, small d. Yeah, but that cost of debt is attached to a tax rate. So we say 1 minus the T, which is the tax rate. Yeah, that's the formula for calculating what? CAPM. Yeah, so when you look at this, all we are given here, we have the cost of debt, but we don't have the cost of what? Equity. Yeah, so we are going to start with this formula here to calculate the cost of the equity, because we'll need it when we are calculating the WACC. Yeah, so therefore, the cost of equity, yeah, this formula up here, so I'll copy it. Yeah, so we lose that formula. So the cost of equity there will be, we start with the risk-free rate. So you say equals to, what is the risk-free rate? So the risk-free rate is here, we're given 1.5. Yeah, just select it. Then you add beta. Beta is 1.3. Good. Then you put a bracket, so you shift bracket. You have the expected rate of market return. The market return here, we are told it is 10%. That one. Yeah, so you pick that 10%. Then you subtract what? You subtract the risk-free rate, which was 1.5. That one. Then you close the bracket, then you enter. Sorry, I don't know why it's giving me that. Let me see. Let me put a bracket here. Then bracket. That one. Then you enter. Let me undo that. So we say equals to the risk-free rate is that value there. You add the beta. Beta was 1.3. Then you create a bracket. Return 10% minus the risk-free rate. This one. So let me create another bracket here. Sorry. Then I'll also put another one here. But then you enter. Oh, why is it not behaving? Yeah, so allow me. Let me work with what is in the bracket first. Expected rate of return minus RF. Let me do it that way. So I'll say bracket. The expected rate market return was 10% minus 1.5 minus the risk-free rate. We'll have that value there. Good. Then this value will multiply by BI, the beta. So you come here, so equals to this one. You multiply by beta. Beta was 1.3. Then you enter. We are working backwards. Then this now you add to risk-free rate. So you come here and say equals to this one plus the risk-free rate, which is now 1.5. That way. You enter. So that you get what we call the cost of equity. So our cost of equity will be 12.55%. Our cost of equity will be 12.55%. So that's what we are looking for. By that formula. It was refusing to work on my Excel sheet. But now I've started by solving what is the bracket, then you multiply by beta, then you add what you get there, you add to the risk-free rate. So the risk-free rate is 1.5. So that's okay. So our cost of equity is 12.55%. Therefore, we ask ourselves, now we can be able to calculate what? Our weighted average cost of capital. So we come here and pick WACC. And the formula is there. So the value of equity, so I'll say equals to the value of equity. So equity value is 16,500. You divide by the sum of equity plus debt. So what was the sum, or what was the equity? Equity value, still this is that one. Then you add to the debt value. That way. And then this is what you multiply. So I'll put a bracket here. Now, once you are done with this, sorry, alternatively, this is what I'm going to do. I'm going to say I'm using this formula. So we have the equity value, which is 16,500. You divide by what? You divide by the sum of these two. So even before I do that, let me just get the sum of these two, equity and debt value. So that I can just pick it naturally. Yeah, so it's 3,500. Yeah, so we'll just come here and say equity, which is this, the value is this. We divide by what? The sum, E plus D, equity value plus debt value, which is 3,500. Sorry, 3,500 is here. Yeah, so once you're done with that, you multiply that by what? RE. RE is the cost of what? Cost of equity. And only that cost of equity, we have it here. Then you add this to debt value. So allow me to put the bracket. Let me just be cautious. Let me put the bracket. Yeah, so I'll add that to the debt value. So debt value is this one, 14,000. So I'll put a bracket here also again. 14,000. You divide by the sum of debt and equity. Yeah, E plus D. Yeah, that's 3,500. Then then you multiply by what? You multiply by the cost of debt. The cost of debt we are given here as 5%. So multiply that by 5%. Yeah, but remember that this has to be multiplied by what? By the tax rate. Yeah, so times 1 minus 1 times 1, my bracket 1 minus the rate, which is 25%. Yeah, the tax rate, which is 25%. That way. Yeah, so after that, you just enter. Yeah, then before the type in your form, you just say yes, so that they can correct it for you. Yeah, so our WACC is 0.085. So you go to here, then you change to percentage. So we had a weighted average cost of capital of how much? Of 8.51%. Yeah, so that's how you're supposed to calculate the weighted average cost of what? Of capital. Yeah, that's how you're supposed to calculate that value. And you get 8.51% using the CAPM. So this is the formula. Yeah, but this formula, in this question, we are to calculate the cost of equity, which we apply this formula using the CAPM. Yeah, so our weighted average cost of capital is 8.51. So we have answered that question correctly. Roman 3. Roman 4, determine the terminal value if after the 6th year, the free cash flows will have a growth rate of 3% indefinitely. So I'll do that here. Yeah, so what will be my terminal value? So just come here and say terminal value. And they've said that it will grow 3% indefinitely. Yeah, so I'll put that 3% here, so somewhere where I can be able to select it. Yeah. Yeah, so terminal value, you calculate it here. Now this is what you do. You will take the last year, because this is the 5th year. We are told that it will grow indefinitely in the 6th year. Yeah. So we will take the 5th year free cash flow times, yeah, this value here, times bracket. You'll introduce a bracket. Then you'll pick 1 plus that 3%. So plus that 3%. And you select it. Then you close the bracket. Then you slash, you put slash, then put another bracket. Then you pick the WACC, which is 8.51. You select it. You subtract the growth rate, which was 3%. Then you close the bracket. Then you enter. Yeah, so once you enter, this will be your terminal value. Yeah, so we use that. That's the terminal value. Yeah, that was the terminal value. And you have answered that question. You have answered that question. Number 5, determine the enterprise value. So We can determine the enterprise value without knowing the total free cash flow to the firm. Yeah, so therefore, I'll have to create, I'll have to insert, insert a row. I'll also have again to insert another row. You insert. Yeah, so that's okay. So we have our terminal value. So therefore, what is the total free cash flow to the firm? So total free cash flow. Yeah, so for the first year, we'll just have this. Enter. Then I'll drag up to the fourth year. Then when it comes out to the last year, so we'll have this plus this as the final value. So we'll have that as the total free cash flow to the firm. Yeah, so at this point now, I'll be able to highlight that. Then I'll create a top border. Yeah, so we have a terminal. We have answered that question. So the enterprise value. So how do we determine the enterprise value? So enterprise value will be that's the NPV. Yeah, so we'll calculate the NPV, the net present value. That's the enterprise value. Yeah, so what will be the net present value? So we'll say equals to, just use the format for the NPV. The rate is what? The rate is the WACC, 8.51%. Then comma, you pick those values the way they are, the total free cash flow to the firm. Yeah, so we start from year 1 all the way up to the last year. Then you enter. Yeah, so our enterprise value is giving me, let me remove that currency to general. Yeah, so it's giving me 47,770.6249 as our enterprise value. So enterprise value simply means the NPV. Yeah, the NPV. Yeah, so that's our enterprise value. Yeah, you are done with that question. You have answered that enterprise value. So the next thing, I said that this was a correction, so I'll give you 3 marks for that. I'll give you 3 marks for that. Determine the intrinsic value. So how do you determine the intrinsic value? So the intrinsic value, let me do it here. Intrinsic value. Yeah, the formula is always the enterprise value divided by the number of shares. Enterprise value divided by what? The number of shares. Yeah, so in this question, we have the enterprise value. We've just calculated it somewhere here. Yeah. Then let us see if we add the number of shares. Yeah, we are just given the equity value, which they are not even specific. Yeah, so you will allow me to add additional information number 8 here. Because there was a confusion with that question. So maybe we say that the number of shares. Yeah, so that I will be able. So you can just say shares are shares held. Maybe 1,000. No, let me say maybe 500. I remember these numbers are in thousands. Yeah, so share held are 500. So therefore, our intrinsic value will be the enterprise value. Which is this? We divide by what? The number of shares, which you are told is 500. Yeah, I've just created that now. It was not on the original question. So it means that the intrinsic value will be 95. Yeah, so intrinsic value is the value per share. the actual value per share. It's called the market price at 95 per share. So in most instances, the examiner will ask you now to compare that with the value of shares you are given previously, so that you can make a decision whether to buy that company or abandon it. And that's the reason for doing DCF, the discounted cash flows. Yeah, that's the main reason why you do valuation of farms, because you can't buy a farm that you have not valued. Yeah, so that's how I expected you to handle that question. So we meet on the next question, and have a blessed evening, afternoon, or morning, wherever you are. So thank you so much for watching.